What's up, everyone? Welcome to my channel, Minority Thinker. Again, they say history does not repeat, but it rhymes. I think this time around, it's not only repeating itself, but it also rhymes as well. Okay, guys? Before I go on and talking about the real estate market, how it rhymes, and also very eerily similar to that of 2006 that led up to what we know as great financial crisis, the subprime mortgage crash. Okay, let's take a look at let's go over what's the market doing, some very important dates that's coming up this week, guys. This is the Dow Jones, basically the chart. So some of the dates that it's important and a lot of people are eyeing on is the Fed meeting. That's potentially the Fed meeting is July 27th and 28th. They're going to meet, and basically to be expected is that they're going to raise 26th and 27th. The expectation is that they're going to raise rate 75 basis point. That's 0.75% or 0.75%, and that's to be expected on July 26th and 27th. And what's also important, need to know, is that the GDP for Q2 is also releasing the day following, okay, the 28th. As you can see here, Q1 2022, negative 1.6%. So you know what's been happening. You see the contraction. You see a lot of turning overs of everything. I would say that this number would not surprise me to go over 2% negative, in the negative 2% territory. So that's technically is in a recession. However, I believe they're not going to come out and say a recession because employment is very strong. So overall, it may not be in a recession, etc., etc. But two negative consecutive quarter technical charts will say that's a contraction. It's going to be in a recession. Okay, guys. So this number, I believe, is going to be over 1.6, guys. So that's what it is, guys. And I want to go over to some of the charts here. Looks like the Dow Jones stock market and even crypto, it's basically shooting up since the last, trending up since the last Fed raise rate. Okay, before that, 5 days or a week before, it dropped. Anticipation of a raise rate, Fed rate, and then it shoots back up. Similar to here, the last time is that it shoots up. This is the Fed, the first, second, third Fed rate hike. Okay, every time it's drop in anticipation, and afterward is pumping up, dropped, pump up here a little bit, but then it drop, pump, drop, pump. So this is the date here, the 27, 28. I anticipate the same pattern. Here is that it pumped up, lead up to it, and then this week it's gonna be pulling back into this trend line here until in this funnel here. It would not surprise me it hit to this 29,500 level. That's a pre-COVID high right there. Okay, this is a pre-COVID high right here, so it would not surprise me hit that right after the release of the GDP, 28th. So that will start, I believe, the end of the recession bounce. Okay, I think the trajectory is very. Let's take a look at the crypto here. Crypto has been pumping too as well. So there's a little uptrend here. It's a little smaller funnel, uptrend funnel, but it's basically it has a bounce all the way up to 24.3. I think that's going to be the last of it, guys. It's going to be just continued downtrend down here. And then I think it's going to do like that at a 12,000 level, guys. So that's my take on it. So a lot of smart money, I believe, is going to cash out right here. It's already cash out here because of its massive resistance here. A lot of folks talking about that it might bounce up to about 25 at this moving average here. 75. This is for my moving average. Hit to this moving average from my exponential moving average of 75 here for me. A lot of folks are anticipate there, but it didn't hit there. It hit here at 24. So yeah, it's anticipation, and this week is very believe it's going to be a risk off week. It would not surprise me if it's continue its downtrend into this funnel here. Okay, so that's that, guys. It's not good. It's not looking good. If you look at all of the news. So again, back into what my take was. History doesn't repeat itself, but it often rhymes. I think this time around it also repeats. It not only rhymes, it also repeat. Okay, let me take a look at what I'm talking about here. The history book here. Okay, this is Realtor sees, this is 2006 article. Realtor sees slowing housing market in 2006. U.S. home sales will drop to 6 as mortgage rates climb, and house prices inch up at rates far below those notched last year. A trading group said on Tuesday, noting a long-awaited housing slowdown has begun. So yeah, I mean, we see housing slow down right now, guys. U.S. home sales will drop in 2006 as mortgage rates climb and house prices inch up at rates far below those notched last year. Trade group said the outlook from a national NAR came shortly after a luxury home builder Toll Brothers, widely seen as a bellwether for housing market, slashed its sales forecast for their second time in 3 months. So if you look at Toll's, what's the headline, guys? Toll Brothers cut to underperform at BOA amid rising interest rate, earning peak in 2022. So outlook for national Toll Brothers, widely seen as bellwether, slashed its sales forecast for second time in 3 months. It seems to me that it repeats, right? Let's see the next article here. Okay. Will subprime meltdown burst the housing bubble? As housing prices continues to make front page news, both buyers and sellers worry over the impact on their personal economic future. So earlier was a forecast of 2006. This is 2007. This is the year toward the end of 2007. That's when the housing market crashed. Okay. At first, the house news focused on miracle of the market as houses in some hot areas increase in price by 20, 30, 50% per year over year after year. Does that ring a bell, guys? 20, 30, 50? I mean, for the past 2 years, we have consistently on average 20, so 40% year over year. Okay? And some market like Boise, Austin, instances 60 to 70% year over year. Does that ring a bell? Then focus turned to crash of the market at the affordability index as comparisons of average house prices to average salary indicates fewer and fewer households could qualify for mortgages. Wonderment and delight were replaced with gloom and doom. The conversation changed from how much will prices increase this year to when will the housing bubble burst? How much will prices decline, or will defaults cause a recession? See that, guys? It repeats itself again. This article is 2007, and it's relevant. It wasn't relevant 2000 because they're still talking about would a bubble burst, which we already knew. 2008, the end of 2007, it crashed. 2008 crashed and went all the way down to 2012 was 2010 was the bottom. That's a 3 years downturn. Okay, so we're talking about this again. Okay, so all this, it will make headlines. And some of you might say, "Oh, I want to be contrarian. I don't want to be in the crowded." So ignore some of the headlines, even though it's a realistic headlines. Okay, I mean, sometimes it's good to be a contrarian, but it's also be a realist as well. So let's go down here. Creation of an asset bubble. The recession in the U.S. began in early 2001, intensified with economic, political, societal uncertainty that followed 9/11. Federal Reserve lowered the interest rate, monetary ease to spur the economy. Treasury bill rates hovering around 1%. Mortgage rates fell to a 40 years low. Does that ring a bell, guys? Right, your zero rate. More household qualify for mortgages, and the demand for houses increased. Creates demand drove housing prices upward. Speculators became active participants in the housing market as a return exceeding those on the other investment. Stock and bond market returns were low or negative and very volatile from 2001 2004, while the prices of homes in California during the same period rose 71%. Does that ring a bell, guys? Austin, for example, Boise, Ogden, Utah, Florida, similar to that of California in 2004 lead up to 2007. Okay, some surveys found real estate investors, many of whom hoped to resell the homes quickly at a profit, bought 23% of the home purchase in the U.S. during 2004. An additional 13% purchases were second homes. Wow, these numbers are very similar to today. We'll see how that's going to play out. Let's scroll down all the way in here to see what are their conclusion. This is their conclusion of all the data that they put out. And so what does this mean? Well, meltdown in the subprime market, decreased consumer spending, decreased corporate profits, and increased unemployment, forcing the economic into recession. This is a question. Will the real estate boom be followed by a bust, as we saw in the dot-coms? So the same exact question is being raised 2007 and being raised again 22. The good news is that unlike stock prices, housing prices do not normally plunge immediately. Gather housing prices drop slowly as they lag a reduction in employment and income. If history is any indication, we will see a return to normal or a correction, gathering a collapse in the market. Well, this didn't age well, is it? It says a return to normal. How many times do you hear on the talking heads talking about the return to normals right now? They say it's going to be a correction, gathering collapse. It might be an opportunity for you guys to buy because it's returned back to normal. And again, this is 2007. How many times you guys hear that? Return to normals, correction, soft landing. This article is 2006 again. Welcome to the dead zone. Real estate survival guide. The great housing bubble has finally started to deflate, and the fall will be harder in some markets than others. This is what I'm saying about, the wise saying that not to follow the herds, not to listen to headlines. But here is the headlines that tell you that the market's deflating, similar to today. Granted, in 2006, 2007, we do not have the widespread of the YouTube, social media, which a lot of folks are spreading the housing crisis as it was in 2006. But nevertheless, when it gets so many folks are talking about it, because it's undeniably real. The sentiment is real. Okay, guys, don't be the denier of the contrarian. I've talked to folks, these obviously small time investors. They're like, yeah, it happens to maybe potentially other market, but it's not this market. It's not my market. My market is still growing. But look at how percentage it's up, overvalued by 20-40%. And let's say if it's decreased by say 15%, they're still up 5%. That's what they're interpreting. But the pullback is massive. Okay, you're going from multiple offers, 10, 20 offers that are 100, 200,000 over asking, to completely negative, like zero off and price reduction within 1 month. I mean, the rate of drop is tremendous. And then they spin it, they're saying that, oh, it's still because the value, the real estate value is so it pumps so much that it has to go back to normalcy. So now it's normalcy. I don't see anything normal about that, guys. I see a complete 180, okay? A complete 180 reverse. And you'll see more of that soon here as the bubble is deflating. And one of the thing about that is you have to look at this right here. Let's look into this. The message is clear. 5 years of superheated. So we have about 5 years, maybe 2 years, the last 2 years. Superheated price gain rescue America from stock market collapse, from billions of consumers' pocket, ignited a building boom that bolstered the nation economy, but it's over. The great housing bubble has finally started to deflate. You won't find the news in broad national statistic or upbeat comments from the real estate industry. The latest official figures, for example, shows both new and existing home sales rising in March, a mixed bag on prices, and a record number of new homes on the market. But fortunes on the ground reporting in what up to now have been some of the cancel. You hear that, guys? These are a leading indicator, okay? Cancel per transaction. Deals are drying up. Prices are starting to drop. Okay, guys? This is 2006. And when did the market crash? Late 2007 and 2008 is full-blown market crash, real estate-wise. The psychology is shifting even as thousands of new homes and condos join their for sales listing each day, so the downward pressure will only get worse. It seems to me that it's a repeat itself, okay? It rhymes and it repeats, because right now a lot of the backlog of building is basically making its way to market as we speak from now until the next 6 months, okay? The buyer's sense of urgency is gone. Yep, the FOMO is gone. CEO luxury builder Toll Brothers, who has long been a housing bull, they see the market going soft, so they stall. Take a deep breath. We're not forecasting the nationwide housing collapse for one thing. The vast expanse of America between the coasts is never touched by real estate mania and is in no danger of a meltdown. And even some overheated market, including Manhattan, Los Angeles, California, Orange County, are still simmering. See, guys, again, they're not going to go out there and tell you, oh, market is crashing. We're just slowing down back into normal. That's what they're supposed to do. Okay? Do not listen to the headlines. Even the headlines here, when they're talking about the burst of the bubble, but yet they're still saying that it's, again, guys, I'm not a pessimistic, gloom and doom types of person, but at the same time, this part of the understand that it's a part of the cycle. So you gotta know when to risk on and when to risk off. But things are very sudden, looking very chilly indeed in 4 coastal cities: Boston, Washington, Miami, San Diego, as well as western boom towns, Phoenix, Las Vegas, Sacramento. So far this year, monthly sales have fallen 11% to 25% in Miami, Boston, Northern Virginia, San Diego, according to a local housing expert. So again, all that seems to be repeating itself. Builders continue layoffs. Pink slip blanket and in the industry, remember there are right and wrong ways to resize your workforce. Yep, so builders, these are all leading indicators. This is 2006. A builder of luxury homes report a 19% drop in profit. Luxury homes reports. Okay? This is today. Redfin. Luxury home sales sink 18%, the biggest decline since the start of the pandemic. Builder continues layoffs, 2006. June job report review impact of layoffs in real estate industry. Okay, so again, I'm flipping back and forth here, but you get the point. Prices cut at Seattle luxury condo towers as housing market cool. July 24th. This is yesterday. Okay. So, leading indicator, luxury condo, luxury real estate will be the first major pullback. Layoffs in the mortgage industry, layoff in the builders. All right, guys, I just want to finish this off by going to one of the only one or two person that I actually listen to about housing market. Okay, that's Ivy Zelman. You know, I'm not going to hype about it, but just do research on her. I don't want to hype it up. Just want to do research on her and then see what do you think.
Strength that we've seen, I think, is being fueled incrementally by what was a pull forward. Young couples that were in apartments that said, you know what? Okay, we're not starting our family yet, but let's get out of Dodge. Let's go get some space. And people ran out of New York City to the tri-state area, or they're now looking at speculating and saying, how do I make money in this robust, crazy market? You know, you hear about crowdfunding and people are finding ways to participate. So it doesn't feel good, but I don't think it's going to be, David, without seeing something change materially beyond what my expertise is. There's a lot of skin in the game. And so there, you know, will there be foreclosures? Yes. The government upheld, withheld in foreclosures, and normally between evictions and foreclosures, we're talking about probably a combination, could be a $2 million person negative impact that wasn't felt and is only now on the margin starting to be felt.
Basically, I just want to add to this and just close it, is that real estate used to be a inflation hedge. Okay. People still perceive that today as inflation hedge. What people don't realize is that real estate now, it's more than ever, more than 2006, 2007, 2008, leading up to that market. So subprime mortgages, that people are speculating on real estate. Easy money, okay? People are buying multiple homes. I know friends that are doing the same, are speculating, which they asked me many times, hey, you should go buy stuff in Florida, buying homes in Florida, either fix to flip or fix and Airbnb it out. I mean, I've seen multiple homes that are being purchased in Florida by people that I know, buying in Texas, multiple homes, and doing the same thing, Airbnb. Arizona, too, as well, multiple homes. Being investors are buying multiple homes in different states to do the Airbnb, and the like what Ivy was saying, crowdfunding. They're basically putting money in together, buying homes, and then basically either rent it out or fix and flip. Okay, I've seen a lot of that, guys, and you can see that you didn't see that in 2006 or 2007. Okay, the primary buyer affordability is not there. Okay, so yeah, this is all gonna come home. Okay, hey guys. But anyway, all right, guys, I'm safe out there. I'm out. Cheers.